Here's an example of the end result, and I call this the Volatility Canyon. Imagine, because I think it looks a little bit like a topo map, a hiking map that people sometimes use when they're navigating. And imagine that this is a path through the center of the canyon. Just bear with me on this metaphor. The dotted line, which is the moving average, the central moving average, is a path through the middle of this canyon. The point is that as Bollinger Band measures volatility, and the further away that you get from that central path, the more likely, what the Bollinger Bands are saying is the more likely you will gravitate back towards that center. And so imagine that this is a topo map, and these represent the steep sides of the canyon, the lines going up. So this is a path through the center of the canyon valley, and these represent the lines going up the sides of the hill on one side and up the sides of the hill on the other side. And so as our drunk stock moves back and forth through the canyon, the further it gets up one of these sides, the more gravity is trying to push it back down towards the middle. That's the metaphor that I'm choosing to use on this one. It, again, is designed to help you understand the personality of Bollinger Bands. And in this case, you can clearly see how as it gets further away from the central one, it moves back more quickly towards that center in a couple of areas. Again, it's more of an educational technique than necessarily a trading technique. It certainly helps you understand the nature of standard deviation, the standard deviation parameter of the Bollinger Bands. So let me continue to expand on this ribbon idea one more time, if you'll bear with me, if you'll indulge me. You can also apply this to indicators. So far we've looked at it with overlays. Remember, indicators are the things that are above and below the chart. The same question as we get all the time. Well, you can use the ribbon concept to learn more about indicators. Here's an example. One of the indicators I love to talk about is the Chaikin money flow. It's a nice indicator because it combines both price and volume. It gives you one thing. I'm not necessarily advocating the Chaikin. This is something that some people love and some people don't love, but it's a great example indicator, and I'm going to use it in this example. So here's the initial stab at a ribbon concept for an indicator. And what we've done here is I've added the Chaikin money flow again and again and again to this chart on the bottom, but I've varied, where are we? There we are. I've varied the parameter as you go down. Now what's very interesting about this chart is it fully illustrates the conundrum and the challenge of interpreting indicators. This is the bane of technical traders' existence. And that is that when you shorten the time period of an indicator, you get a lot of whipsaws. You get a lot of signals, and many of the signals are whipsaws. A whipsaw is something that's a false signal. So for instance, just to make sure everyone's on the same page, see this, let's just assume that we're doing a very simple interpretation of this Chaikin money flow indicator. And our simple interpretation for the sake of this discussion is crossing the zero line. So we're just saying it's bullish when it crosses above and it's bearish when it crosses below. Well, notice, for instance, right here, that it crossed above zero and immediately went right back down. I'm talking about, in this case, I'm talking about this little one right there. That's an example of a whipsaw because if you bought, you'd immediately have to sell, and it kind of tends to drive people nuts. So very short-term indicators and indicator periods give a lot of signals, but the signals, it also gives a lot of these whipsaws. There's a whole bunch of them right there at the very right side of this chart. On the other hand, look at the indicator at the bottom of this chart. This is a very long-term parameter, and it only gives two signals. Unfortunately, one of them is a whipsaw, which is not good. But most of the time, longer-term indicators will give very strong signals, and those signals will last for a tradable period of time, a period of time that somebody that is not a high-frequency day trader can actually deal with. And you see here, it's a very clear signal right there in the middle of October on this chart. What could be clearer? No good, good. You'd love if all your signals were that way. Well, what's the problem with using a long-term indicator, however? It's slow. You have this delay. Notice that this signal happened probably a long time, almost a month after the stock started to turn around. It's actually not too horrible from that point, but from here it was a very long time. You can actually see this, and this is the value of doing this ribbon and learning about the personality of the Chaikin using this ribbon technique. Notice, and I'll show this over here in a second, here's the long-term signal. Notice that same signal happened a little sooner on our 40-period Chaikin. It happened a little sooner on the 20 period, and even a little sooner on the 10. Unfortunately, on the 10, it's not nearly as clear that that's a significant signal as it is on the longer-term ones. But notice there's this kind of sloping horizontal or sloping vertical line that connects those signals, and that illustrates the lag involved in that signal as you go longer out. And what I was talking about was the signal's there, the strong one. Here it's a little sooner, there it's a little sooner, and there it's very soon, but it's certainly not clear that signal is more important than, say, this one over here. So that's the trade-off. That's the nature of indicators, and that's why a lot of people say don't use just one indicator. You need confirmation from other stuff, so on and so forth. My main message again here is just to illustrate the ribbon technique and how it really makes all of these issues very visual and right there in front of your face.